Hello, and welcome back to our channel. Today, we're diving into a topic that's been making headlines around the world for weeks: the global trade war initiated by the United States under President Donald Trump. This conflict has reshaped trade relationships with countries like Canada, Mexico, China, and Europe, and it raises some big questions about how nations interact economically. Our goal is to break down the basics of trade wars and trade deficits, clear up some common misconceptions, and revisit a few key economic concepts from our Economic 101 series. We'll also explore the challenge of reducing a trade deficit and its connection to the US dollar's role as the world's reserve currency, all from a neutral, fact-based perspective. Let's get started. Section 1. Key Trade Concepts. Imagine you're at a farmer's market. You sell apples, and your neighbor sells oranges. One day, you decide to charge your neighbor a fee for selling oranges in your stall. In response, your neighbor charges you a fee for selling apples in theirs. This back and forth is essentially what happens in a trade war. Countries impose taxes, called tariffs, on each other's goods, and the other country responds with its own tariffs. The goal? To protect local industries and address trade imbalances. For example, the U.S. recently imposed tariffs on steel and aluminum imports to protect domestic jobs and industries. But this move didn't go unanswered. Other countries responded with their own tariffs, escalating the conflict. Now, let's talk about trade deficits. Imagine you love buying oranges from your neighbor, but they rarely buy your apples. At the end of the month, you've spent more on oranges than you've earned from selling apples. That's a trade deficit, when a country imports more than it exports. For the U.S., this means buying more foreign goods, like electronics and cars, than it sells abroad. But here's the twist: a trade deficit isn't necessarily bad. It's just a reflection of market transactions, like spending more on groceries than you earn from your garden. It doesn't mean you're losing money overall. Is a trade deficit the same as subsidies? Now, here's where things get interesting. Some people think a trade deficit means the U.S. is subsidizing other countries, essentially giving them free money. But that's not true. A trade deficit is just the result of buying more than you sell. Subsidies, on the other hand, are direct payments or financial support that governments give to their own industries. For example, if the Canadian government gives money to its dairy farmers to help them compete, that's a subsidy. But when the U.S. buys Canadian oil, it's not a subsidy, it's just a transaction. Dollars flow out when we buy foreign goods, but they often return when foreign companies invest in U.S. assets. It's a natural exchange, not a handout. Let's take a quick refresher on some basic economic concepts. First, demand and supply. Demand is how much of a product people want to buy at different prices. For example, if the price of American-made cars drops, more people might buy them. Supply is how much producers are willing to sell at various prices. When prices are high, companies are motivated to produce more. These principles help explain how markets work. For instance, when tariffs make imported goods more expensive, consumers might buy fewer of them and switch to domestic alternatives. At the same time, higher prices for imports can encourage U.S. companies to produce more. But here's the catch: many imported products are made more efficiently abroad, so forcing all production to be domestic could raise costs and prices for everyday goods. Section 3. Connecting economic concepts to trade wars. Now, let's connect these ideas to the trade war. Tariffs might reduce imports temporarily, but they often lead to retaliation. For example, when the U.S. imposed tariffs on Canadian steel, Canada responded with tariffs on U.S. products like ketchup and whiskey. This tit-for-tat can hurt both sides, raising prices and creating inefficiencies in the market. Instead of a full-scale trade war, a balanced approach, enhancing the competitiveness of American industries while still engaging in mutually beneficial trade, is usually more sustainable in the long run. Finally, let's talk about the US dollar's role as the world's reserve currency. Many countries hold US dollars because they're considered stable and reliable. When the US runs a trade deficit, dollars leave the country to pay for imports. But these dollars often return when foreign governments and investors buy US assets like treasury bonds. This cycle helps sustain global demand for dollars. While reducing a trade deficit might seem like a good goal, the dollar's international role is driven by confidence in the US economy, not just the trade balance. In summary, today we've discussed that a trade war involves reciprocal tariffs, while a trade deficit simply means importing more than exporting. A trade deficit isn't the same as subsidies. It's just the result of market transactions. Basic economic concepts like demand and supply help explain how trade policies work. Reducing a trade deficit requires boosting exports and, in some cases, reducing imports, but trade wars can lead to retaliation and higher prices. The US dollar's role as the world's reserve currency is driven by global confidence in the US economy. Trade is a complex but fascinating topic that connects countries and affects our daily lives. If you found this explanation helpful, please like, subscribe, and leave your questions in the comments below. Stay tuned for more videos that break down complex subjects into clear, understandable parts. Thanks for watching, and see you next time.